This is the Flow Show, brought to you by Michael Hartnett and his team at Bank of America, narrated by yours truly. Q1 was about recession fears, now we're on to this Goldilocks situation. Hartnett is calling it greedy and a little bit bubbly. Take out the big 7 in the S&P, the rest of the companies, the other 493 are up 1.2%. That's not new, but there is interesting stuff in this report, so grab a bite to eat, relax, this is going to be 6 minutes. Or save it and come back to it later. As always, this is going to be on my LinkedIn, my link is in bio. Flows last week, there was another $70 billion to cash, $14 billion to bonds, $7 billion to stocks, and $0.5 billion from gold. Bank of America's AUM is growing. There's just so much money out there. They're trying to put it to work anywhere, including cash. Investors are loving cash. Inflows are almost as big as the mammoth 2020, approaching $1 trillion. Bonds and stocks both did well. Stocks had its strongest 2 weeks since January 2023. Tech had its first weekly outflow in 8 weeks, after a record last week. Japan and China both saw inflows. This year, asset allocators are long cash, long institutional grade bonds, and short stocks. When investors love high grade bonds, stocks usually do well. Bank of America remains bearish and still thinks the pain trade is to 6% on the Fed funds rate, not 3%. They think that to get less than 3% inflation, we need more than 4% unemployment. Summer rip and risk assets will raise interest rates and tighten financial conditions. I disagree with their outlook, but here are some trades that they're giving us. Long Hang Seng, which is Hong Kong, and short AI. They think a combination of a weak currency, low bond yields, and low oil means that Chinese financial conditions are the easiest since September of 2020. People's Bank of China is cutting interest rates in order to tackle 20% youth unemployment. This, along with calmer U.S.-China relations, should bring up stocks. They don't like U.S. tech and AI, comparing it to long-term capital management, and they're expecting higher rates to cause angst in the big 7. I say skip that trade. They're also long oil regional banks and real estate, and short home builders and high-yield bonds. Saudi cut of 1 million barrels per day has not led to higher prices. The 5 out of the last 7 times this has happened has led to a recession, but they believe that recessions are already priced into oil stocks, REITs, and banks. That's why you should go long them. I agree, I like all commodities, most commodities. They list U.S. cardboard sales as a forward-looking indicator. This is because people aren't moving out of their houses. This is why they're short home builders. And they say tech and luxury are priced for no landing, therefore faded. As for high yields, the default rate is up 3.1% in May versus 1.9% in December. Bankruptcies are up 38% year over year. 1 percentage point move in unemployment data is usually consistent with 250 basis point move in high yield corporate bonds. They think the spread between high yield and institutional grade bonds is going to grow. As for yields, this is the Australian 2-year and it's at a 12-year high. The Canadian 2-year is also spiking. Real rates remain low or negative, while they expect inflation to re-accelerate. Having real rates lower, hence why they think the Fed's going to continue to raise rates. This is a graph of Chinese financial conditions. The average percentile of the Chinese 10-year, the yuan, and oil prices being at 19.5%. And here's the Strategic Petroleum Reserve. Harder to say than it looks. It's at the lowest level since 1983, and remember that Biden promised to refill this. Again, sharp declines in oil prices usually lead to recessions. We already have one in Europe, but the US remains strong. Meanwhile, cardboard boxes haven't been this weak since the global financial crisis. And shipping rates have flatlined back to their pre-pandemic levels. Look at that huge spike over COVID. Down 85 to 90% from its peak. The ISM manufacturing backlog has diverged from the US 5-year. Something usually gives. The manufacturing index is down to recession territory, meanwhile the high yield to institutional grade spread is not, despite the fact that the high yield default rate is up. This is a visual of the investors piling into cash, up at $8 trillion. And the flow to know is that investors are long institutional grade bonds and short stocks. Large cap flows have peaked, meanwhile small cap flows cannot catch a bid. Last week we broke a record for tech inflows, and that unwound this week a little bit. Equity flows are basically flat year to date, which comprises of an inflow to emerging markets and an outflow from developed markets. Investors have been buying Japan and selling energy the past 4 weeks, while equity allocations are at 60%. Debt allocations are at 21%. U.S. large caps are the best performing asset class of this year. The bear bull indicator, which is the best indicator of what you should be doing, remains on the buy side. The only asset class outperforming U.S. equities is Japanese equities. Meanwhile, as far as stock markets go, Greece, Mexico, Taiwan, and Korea have all done really well. Turkey and Hong Kong have done very poorly in comparison. When it comes to sectors, information technology has dominated, followed by telecoms and consumer discretionary. Energy and biotech are the worst performing sectors. When it comes to fixed income, the worst quality bonds have done the best. Meanwhile, Japanese government bonds have done the worst. As far as FX goes, Bitcoin's been dominating, followed by the Mexican peso and the British real. Worst performing currencies are the Japanese yen, the South African rand, the Norwegian krone, and after a terrible week, the Turkish lira comes in last by a long shot. Meanwhile, as far as commodities go, gold leads. Copper's had the least bad of a year. Crude oil's the worst. Hope you enjoyed this. Throw me a like if you did.